Equity release. Equity release is a means of retaining use of a house or other object which has capital value, while also obtaining a lump sum or a steady stream of income, using the value of the house. The catch is that the income provider must be repaid at a later stage, usually when the homeowner dies. Thus equity release is particularly useful for elderly persons who do not intend or are not able to leave a large estate for their heirs when they die. The reverse mortgage is a form of equity release that is available in Australia, Canada, the United States and the United Kingdom. Types of arrangement. Advantages. Disadvantages. United Kingdom. The UK equity release market is basically made up of two types of equity release plan. The most popular plan is a lifetime mortgage, where the homeowner retains ownership of the property but the property is charged with the repayment of a loan or mortgage, which accrues rolled-up interest over the period of the homeowner's lifetime. To help customers decide whether equity release is right for them, a number of companies provide a free equity release calculator to show a rough estimate of the amount of equity that could be released. The other type of plan is a reversion plan, where the homeowner sells all or part of the property to the equity release provider in return for a right to remain there rent-free. The UK equity release market is now fully regulated. Both lifetime mortgages and home reversion plans now fall under the remit of the Financial Conduct Authority, FCA. Prior to FCA regulation, many lenders signed up to Equity Release Counsel, ERC, formerly known as Safe Home Income Plans, SHIP, a voluntary code of conduct that provides a number of guarantees. ERC was formed in 1991 in an attempt to improve the equity release market and its previous poor reputation. The ERC guarantees include a guaranteed right to remain living in the property which is the subject of the equity release, either for life or until entry into long-term care. In addition, there is a vital no-negative equity guarantee, which essentially guarantees that the amount to repay the equity release plan on death or entry into long-term care can never exceed the value of the property itself, and so no debt can ever be left behind for beneficiaries of the equity release borrower. In 2012, SHIP rebranded as the Equity Release Counsel, ERC, and extended its reach to equity release advisors as well as product providers. The current members of ERC include Aviva, Bridgewater, Key Retirement, Bauer, formerly Bauer Retirement, Hodge Lifetime, Just Retirement, LV Equals, More to Life, Legal and General Home Finance, formerly New Life, Retirement Plus, One Family, Equity Release Supermarket, Responsible Lending, Responsible Life, Canada Life, formerly Stonehaven and then Retirement Advantage, and Pure Retirement. Whilst a number of equity release providers, most notably Prudential, exited the market in the wake of the credit crunch, this trend has been reversed since the end of 2010, with a number of these companies, including More to Life, New Life and Stonehaven, keen to attract new customers once again. In 2010, £910.6 million of equity was released by UK homeowners using regulated equity release, with this rising year on year to £1.38 billion in 2014. By 2017, the equity release industry had grown significantly, with over £3.06 billion of lending. In 2018, Retirement Advantage was acquired by Canada Life and Responsible Lending entered the market. Pricing of no-negative equity guarantee. The UK Prudential Regulation Authority expressed concerns in 2018 that firms investing in ERMs should properly reflect the cost of the no-negative equity guarantee. Its consultation paper CP 1318, published 2 July 2018, provided a benchmark for valuing the guarantee. The paper recommended modeling the guarantee as a series of put options expiring at each period in which cash flows could mature, weighted by the probability of mortality, morbidity and prepayment, using a version of the Black-Scholes pricing formula. It recommended that the underlying price of the option should reflect the cost of deferred possession of the property, independent of any assumptions about future property growth, warning that many of the approaches presented to it implicitly assumed negative deferment rates. United States.